In this video, I'm gonna introduce you to this awesome indicator that you can use to filter out noise and false signals and overall increase the win rate of your strategy. If you happen to find value in this video, remember to leave a like. Let's get into it. Now, to get started with this indicator, we're gonna go to TradingView, which is the trading platform that I'm gonna be using. If you need to sign up, the link for that is gonna be in the video description. Next, you wanna load any trading security that you like in any time frame, and then you wanna open the indicator search tab, and then type in Polynomial Regression Keltner Channels. Be sure to select this one by chart prime. Now, the name of this indicator is Polynomial Regression Keltner Channel, which is a pretty long name, but can be abbreviated as PRKC. For the rest of this video, I may refer to this tool as PRKC. So, what exactly is the PRKC indicator? Well, this is a technical analysis tool which was designed to enhance trend detection, volatility assessment, and the detection of overbought and oversold levels in the market. By combining the polynomial regression with dynamic Keltner channels, this indicator provides traders with a comprehensive view of market dynamics. It's made up of the following components. First, we have the polynomial regression basis line, which is the main component of this indicator. It's this line in the center, which is going to help you identify the overall trend direction of the market. When the market is bullish, the basis line is going to be a solid line angled upward like this, with the price trading above it. However, when the market is bearish, the basis line is going to be a dotted line, and it's going to be angled downward like this, with the price trading under it. Now, if you take a look at the top and bottom of the basis line, you're gonna see 4 lines at the top and 4 lines at the bottom. These lines, ladies and gentlemen, are called the Keltner channels. They create a channel or a tunnel around the basis line by placing bands around it. These bands are used to indicate the typical range where the price is expected to move. When the price moves outside of these bands, it might indicate that something unusual is happening. Maybe that the trend of the market is too overextended in one direction. We also have reversal signals, which are these blue and orange dots at the bottom and top of the Keltner channels. The reversal signals are going to be used to indicate when the market is about to change direction, giving you an opportunity to buy low or sell high. This is a bearish reversal signal, which means whenever you see this, you might want to consider taking short positions. On the other hand, this is a bullish reversal signal. Whenever you see this, you might want to consider taking long positions. Now, the next thing we're going to do is go over how we can use this indicator to trade. But before we do that, let's take a look at its settings and see how customizable it can be. First, we can see that we have the option to change the length. It has a default value of 100. If you want to capture longer-term changes in price, you may want to set this to a higher number. But if you want the indicator to be more responsive to tiny changes in price, you can do the opposite. You can set this to a lower length, something like 50, 30, or 20. The source determines the price data used for calculations. Adjusting this can fine-tune the sensitivity of this indicator to price changes. For me, I'm going to leave this at the default value of HLC3. The base ATR multiplier sets the initial width of the Keltner channels before any dynamic adjustments. Increasing the multiplier is going to widen the channels, potentially reducing the number of reversal signals. But decreasing it is going to produce more signals, but with a catch. The more signals you get, the more noise you also get. So for a balance of both, I'm gonna stick with 3. Now, if you wanna adjust this indicator even further, you can take a look at the Style tab and make your changes. After you've made your changes, click OK, so we can take a look at how usable this indicator can actually be. Now, the first use of this indicator is gonna be trend identification. So how do you identify the trend of the market using this indicator? Well, we're gonna be using the basis line. For a bearish trend, as mentioned earlier, the basis line is going to be dotted and angled downward like this, with the price consistently trading under it. Conversely, for a bullish trend, it's going to be a solid line angling upward like this, with the price trading above it. Now, whenever you have a bullish trend like this, the only trading opportunities that you're going to be looking for are continuation entries to the buy side or reversal entries to the downside. Number 2, this indicator can also be used to identify overbought and oversold areas in the market. So how can we use this indicator to identify these areas in the market? You may be thinking, well, it's really simple. Whenever the price breaks outside of the uppermost level of the Keltner channels, that is a potential overbought market, and an orange reversal signal is going to be printed, which is going to be your cue to consider taking short positions. The opposite of this is true for oversold conditions. It's going to be identified whenever the price breaks outside of the lower level of the Keltner channels. As soon as that happens, a blue reversal signal is going to be printed, acting as your cue for potential long entries. Now, a good example of a strategy like this is going to be as simple as this. You, first of all, identify a downtrending market. Once you have it, you wait for the price to break outside the lowermost level of the bottom Keltner channels. Once that happens, you want to have at least 5 candles that open and close under the lowermost Keltner channel. Once you have that, you wait for a blue reversal signal to be printed. As soon as you have the signal, you take a long position. You want to place your stop loss under the most recent swing low, and you target a risk-reward ratio of 1 to 1.5. As you can see, that trade was a profitable trade. And of course, for a short position, you do the opposite. You identify a bullish trend. Once you have the trend, you want the price to break outside the topmost level of the upper Keltner channels. Once that happens, you want to have at least 5 candles opening and closing above the upper Keltner channel. Next, you wait for an orange reversal signal to be printed, and then you take your short position. Place your stop loss at the swing high. The take profit is going to be at 1.5 times the risk. And as you can see, this trade was profitable. This indicator can also be used to spot breakout areas in a ranging market. This is going to happen whenever the price crosses the outermost band. In a ranging market, if the price crosses above the upper outer band, that is a possible bullish breakout. This will indicate a strong upward momentum, and whenever this happens, you may want to consider taking long positions. Conversely, whenever the price crosses below the lower outer band, that is a potential bearish breakout, which indicates strong downward momentum. Whenever this happens, you want to consider taking short positions. Now, to increase the success of such a strategy, you may want to add a volume indicator. Now, during these breakouts, you want the volume to be higher than normal to add extra validity to your entries. Lastly, this indicator can also be used as a support and resistance indicator. This is how that is going to work. In a bullish trend, the price is going to be trading mostly above the basis line, but every now and then, it's going to do a pullback and come all the way back to the basis line and bounce off it, meaning the basis line is the one that's going to act as a support or resistance level. In a bullish trend, for example, the basis line acts as a support level, and in a bearish trend, the basis line is going to act as a resistance level. In this particular trade example, we can see that the price found support at the basis line, but for a strategy, we of course would need to add an extra confluence. Now, to get that confluence, we just want to look to the left and see if there is any resistance or support level that we may want to extend to the right. Right here, we can see that we have this resistance level. If we extend it to the right, you can see that the price broke that resistance level here, which turned it into a support level. Price then tested the new support level, and it tested it here, here, and lastly here. So not only did the price find support at the basis line, but at a previous resistance level as well. This, ladies and gentlemen, increases the probability of this becoming a profitable trade. If you were to take this trade with the stop loss just under the level and target a 1 to 3 risk-reward ratio, well, you can see that this trade was profitable. In summary, the Polynomial Regression Keltner Channels indicator combines a dynamic trend line with adaptive volatility bands to help you identify market trends, support and resistance levels, and even detect overbought and oversold areas in the market. If you want to check this indicator out, you can find it on TradingView. Remember, this video is not financial advice, so do your own due diligence before investing with any strategy. Well, that's about it for this video. If you found some value, remember to leave a like and even consider subscribing to stay tuned. Thanks for watching. Goodbye for now.